Welcome to this session. In the previous session, we have discussed the basic concept of asymmetric information. Then we said that how asymmetric information leading to market failure and selection bias by using the examples of used car market. In this session, we will extend the discussion. We will see how this kind of market failure, asymmetric information and market failure would happen in various different types of finance markets. So let us start with how this would happen in individual insurance market. So individual insurance market, for the sake of simplicity, let us take it individual health insurance market. Consider a situation where people can purchase individual health insurance policy. So in a individual health insurance market, the problem for insurance companies is that they do not know who has the highest risk of health expenditure, or what are the potential health risk of the potential purchaser or potential consumers or potential insurer. As compared to insurance companies, you know that people themselves have an idea whether they are a high risk person or not. If you just think about yourself, whether you are going to buy a health insurance or not, and if you not, you know the reason, right? Because you think that you are healthy and you think that the probability for or the propensity to consume healthcare products in the next 1 year may be very less. Your forecast is think that you may not be needing any hospitalization, so why would you simply buy a health insurance product, right? So however, at the same time, if someone having any health risk or having seen that he or she is having a very chronic disease conditions, and also anticipate that he or she is going to get hospitalized, and then the person will be more motivated or incentivized to purchase a health insurance product. So why? So simply here in this case, what we have seen that between insurance companies and prospective customers, consumers, we can see that there is asymmetric information about the health risk. Health risk is the parameter where we can observe that there is asymmetric information. Because of this asymmetric information, it can lead to market failure in insurance market. It can lead to poor performance in private insurance market. So let us explain, let us discuss how asymmetric information is going to result the poor performance or poor working of private insurance market. So we introduced the concept called selection bias in the used car market case, where we discuss the market will be overrepresented by used car, that poor quality car. That means at the end there will be only poor quality car, and finally the used car market will collapse. So here also the idea here, the selection bias which we discussed there, the proper definition for selection bias is that actions by insurers and consumers to exploit unpriced risk heterogeneity, that is the health risk, and break pooling arrangement. So actually when we talk about insurance means it's a pool of high risk and pool of people with a different risk, that the high risk, medium risk, low risk. So it should be a mix of all kinds of risk involved. Suppose we see that in a society, for example in any country, for example with a 1 billion population, if you know that actually 1 billion, that the 100 crore, suppose we see that 1 crore is going to needing 1 crore population needing hospitalization in the next year, then remaining 99 crores won't need any hospitalization. This is the based on data about the hospitalization probability, hospitalization episodes, we come up this data, for example. So that means in this you know that 1 crore is high risk population and 99 crores are low risk, right. So accordingly we know that out of this only 1% of the population is needing hospitalization. So how an insurance company will underwrite the policy, it will be based on this information. That means only 1% is requiring hospitalization and remaining 99 they don't need, right. So if they assume that all the 101 billion population, 1 billion entire population is joining the insurance, so they need to pay the claim only to this 1%, right. So what they will do, so they will be calculating the risk premium in a way that what will be the total expenditure for example this 1 crore, suppose they will be needing for example 10 billion $10 billion suppose $10 billion is the total health expenditure for this 1 crore population, right. You know that then the remaining for the 99 we already know that is going to be only 0 billion, that means 0 expenditure for this 99 percentage. So based on this what we can see that when they do the pricing, you know that if their assumption is that all the 1 billion population will join the policy, and accordingly the total health expenditure is 10 billion only, 10 billion plus 0 billion. So you know that is only 10 billion, that means 10 billion divided by the entire population, that is 1 billion, right. So accordingly you know that the risk premium is going to be $10 only for this policy, right. Plus this is the premium calculated based on the risk profile, risk premium, plus they will add the operating cost plus profit, that also include the profit as well. Suppose assuming that this one is 2 the per unit policy, you can see that per person has to pay $12 if we make this calculation to buy this policy, given this is the health risk profile of this population. So this is the overall scenario. Suppose actually you know that not all this 1 billion population is going to join the join the policy, not that actually this proportion, that the 1 to 99, that the 1% is risky, high risk, this 99 is low risk. So this proportion, that the 1% 1 to 99, this proportion, even if not all the 1 billion is joining, even if 1 crore, suppose in the total pool, if it is going to be 1% is low risk and high risk and 99% is low risk, then is fine. Then this calculation which we came up here, that the risk premium 10 and the loading cost or operating cost is 2, then this calculation hold true. But what is going to happen really in the market? Really in the market is that actually this won't be the case. We know that those who thinks that a risk, because for the insurance company, they cannot clearly identify out of this 1 billion or out of this entire population who are this 1% who is having high risk, who are this 99% population who are having low risk. That insurance company cannot directly identify those people. But among this 1 billion, you already know that people, that 1%, they most of them may be knowing that about their health condition, that they are high risk population. So this information asymmetry, obviously we are going to see that the actions by insurers and consumers, the potential consumers, they are going to exploit this unpriced risk heterogeneity, and as a result we are going to see that this is going to result in break pooling arrangements. That the pooling means actually insurance means this risk pooling, that risk of this low risk and high risk, this pooling together, then coming up with this way, that coming with this insurance, this premium, and selling the insurance product, underwriting that, selling the insurance product in the market. This is actually a kind of pooling arrangement, risk pooling. Risk pooling means different types of risk. And however, as we discuss here, that but because of this information asymmetry, because this would lead to adverse selection problem that we are going to discuss shortly. And another case actually insurers, if they have some other kind of information, if they do something else to overcome this adverse selection, it would also lead to cream selection problem. Let us see the case of adverse selection issue. So, suppose that when the risk pooling is going to over represented by high risk population. Suppose we saw that actually in this population we know that 1% is high risk and remaining 99% is low risk, but due to the information asymmetry we know that since the joining to insurance policy, buying is a voluntary decision of prospective customers. So, you see that if it is those who are feeling that they need more healthcare consumption or they are going to fall sick and needing hospitalization, if they are going to join more, suppose the red color smiley, suppose they let us call them the high risk, this is the high risk population, high risk, and this light blue color we are going to see this is the low risk. Ideally, it should be say that 1% of high risk and 99% of low risk. But actually what is going to happen that this market is going to be over represented by high risk people. So, in this case what you can see that when an insurance policy is sold in the market, and actually this market will be over represented by high risk population, that means high risk customers. So, those who needing hospitalization. So, in this case because here you can see that from the figures here you can see that the smiley is over represented by high risk population. So, then the calculation which we made in the beginning, that means the premium based on the if appropriate representation is happening, then we found that the premium is going to be $12 only, right. But in this case we are going to see that our calculation the premium 12 is not going to hold true. So, because of this you know that because of this one you know that in the next circle when the insurance company is underwriting the policy, they know that this market actually over represented by high risk population, high risk insurees. So, as a result they will be redoing this calculation and the premium is going to increase. And let us see this, before going to that let us see this scenario. What you can see that since individual themselves know much about their health condition than insurance companies, people who insure themselves are those who are increasingly certain that they will need health insurance and buy more insurance as compared to individuals who thinks that they do not need insurance. As compared to low risk people, with the high risk people will get insurance coverage, they will buy. So, those purchasing insurance are a non-representative portion of the population, right. So, this lead to a situation of buying of health insurance by high risk people and thus resulting of over representation of such high risk people in the pool. Now, let us see if this scenario happens, what is going to happen in this market. Now, we know that the premium is once this happens, the premium is not going to be this $12 at all. This is going to increase. This is going to, for example, the new premium may be, for example, based on this calculation, the new premium for example is going to be 200. So, in this example we know that though it is over represented by high risk population, we can also see some low risk population as well here. But if the premium increase, if its premium because of this adverse selection, the companies will be their new calculation suggests that the premium has to be increased accordingly, and when the premium increase, now let us see what is going to happen. So, when the premium increase, some people for example they think that is better, you know, what is the point of giving 200. So, they eventually leave the market. Maybe when the renewal of this policy at that time, those who did not use health insurance coverage, who did not make any claim, who know that they are healthy, low risk, what they will do? They will think that they will eventually leave the market. When they leave the market, gradually when they leave the market, what is going to happen? You see, because of the adverse selection, the premium has increased, and again in the subsequent circle we are going to see that the market will be overrepresented by high risk people only. So in this case, now if the insurance companies is going to do the underwriting due to the actuarial calculation, they are going to see that this population actually only represented by this high risk, and actually the premium will be the average of the total healthcare expenditure. Suppose the total healthcare expenditure here, whatever we get, actually the premium is going to be almost that suppose the total healthcare expenditure is 10 billion. Now this will be represented by only, for example, 0.1% of suppose 1 crore population. So accordingly, you know that actually the premium is going to be 1,000, right? $1,000. So that means $1,000 will be the almost the average of the hospitalization expenses. So in this case, the premium is almost equal to the average of the hospitalization expenditure. Then what is the point? Actually this market is now only with them, and what is the point? For example, the operating cost for this for each of the policies, for example, then it is, for example, 10, then is going to be this much, right? This is going to be the new premium. So overall what you can see that this market, this is now more with high risk people, and you can see that this is nothing but adverse selection. So what we are going to see that this kind of market won't exist. Even this person also will think that why should I pay 1,000 premium, because I am not using it. I don't need insurance policy as such. I am feeling myself healthy. So this is actually will be more with unhealthy people. That means it's an adverse selection in insurance market, right? So that means this market will collapse. This is called a kind of market failure in insurance market. And in order to overcome this, sometimes insurance companies, they will give insurance coverage. They will do a cherry picking. They will exclude, they will make it clear that those who with previous health histories, health problems, hospitalization episodes, those who have been hospitalized earlier, those who are having chronic diseases like for example heart disease, or having some chronic risk factors like diabetes, hypertension, they won't be given. And not only that, and if they say that they are not going to give insurance coverage to, if they deny insurance coverage to older people, elder population, and they only give insurance coverage to, for example, those with age group of, for example, 18 to 40 or 45, for example, if they limit it, of maybe, for example, 40, this also suppose with another premium, for example 55, suppose they give only to low risk population, then you can see that this market will be, they will be cherry picking. They actually deny insurance coverage to unhealthy population, and those, for example, elderly, because elderly, once you grow old, you know that after certain years your health stock start deteriorating, then you need to restore your health, you need more consumption of healthcare products, healthcare expenditure increase, right? So that means age is a indicator for screening, right? Age is a indicator for screening to identify that a senior elder population is high risk. And similarly, those who had earlier health expenditure, hospitalization episodes, and with a chronic disease condition, and they will be excluded, and this market will be overrepresented by cream selection. This is another case of market failure. Here also actually the purpose is not being served, is only with the low risk population. So the cream selection, the definition for this one is the practice of excluding the unhealthy and sick from the insurance coverage by insurers. So the solution here is actually compulsory universal coverage. That means government come up with the regulation that there should be compulsory universal coverage. So because of this asymmetric information, we said that the market failure happened. Actually there are mainly two types of market failure happen. One is the adverse selection, which we already discussed. This another one is moral hazard issue, which we will discuss in some of the next session. So actually this issue can be better understood by agency theory, which analyzes how asymmetric information problems affect economic behavior. So, the point which we discussed, the selection problem or the adverse selection occurs before a transaction occurs. Before is a ex ante outcome. So, before a transaction occurs, then that there actually the adverse selection occurs. And the second concept, that another kind of market failure due to asymmetric information, that is arises after the transaction has developed, transaction has settled. So, after that, so this part, as I mentioned, we will be discussing in length in the next section. So, let us continue this adverse selection, the first part of the market failure problem. Let us now see how adverse selection influences the financial structure. So, if quality cannot be assessed, so this adverse selection, let us also call it as lemon problems, that is low quality car example. So, is popularly known as lemons problem, the adverse selection problem. If quality cannot be assessed, the quality of, for example, the quality of bonds, the quality of stocks, it cannot be assessed, the buyer is willing to pay at most a price that reflects the average quality, and sellers of good quality items will not want to sell at the price for average quality, right. And then the buyers will decide not to buy at all, because all that is left in the market is poor quality items. That is what we have seen by discussing the examples of used car. So, this problem, so what we can see that in the market, it will be whatever is left in the market, this is only going to be the poor quality items. So, that means in the market between buyers and sellers, if it happen, for example, bonds, stocks and insurance product, which that also we have discussed, then we are going to see that if adverse selection problem is there because of the asymmetric information, that is a reality, asymmetric information. Because of that, because of this asymmetric information that is leading to adverse selection or lemons problem, it explains fact number 2 and partially explain fact number 1 which we discussed. So, what is fact number 2? Issuing marketable debt and equity securities is not the primary way in which businesses finance their operations. And fact number 1 is stocks are not the most important sources of external financing for businesses. So, in this case, what you can see, for example, fact number 2 and fact number 1, look at, for example, on the supply side of stock or bonds. So, let us, for example, look at the supply side of stock. So, due to asymmetric information, some good companies may be afraid that stock might not get its full economic price. So, the companies with the strong economic fundamentals, having a strong good financial project, who is also going to see that their project is going to be a great success and going to earn huge profit, and accordingly they expect that they expect a high IPO, the unit price of their share, they are expecting a high amount. But because of the asymmetric information, because the prospective buyers of their stock may not be knowing whether this company is in good financial condition or they are in a low risk or not, the prospective buyers may not be knowing. So, as buyers of the IPO cannot distinguish the quality of the companies. So, here clearly what we are going to see that as the prospective buyers cannot clearly know which firm is good quality. Somebody is two firms, suppose not only two, many firms when they are issuing IPO, if the buyers cannot clearly distinguish which company is of good quality, which is the peach and which is the lemon, if they cannot distinguish, you know that they are going to pay only the average of quality price, and eventually you also know that here this market will be overrepresented by low quality, because good quality companies they want a high IPO, the high rate of IPO, that price for their stock, but they won't be getting it. Similarly, bond also the same issue. There may be the companies who is borrowing from the market, those with good economic fundamentals and with good business prospects may not be able to. They actually expect that when lower the risk, we have discussed in the previous session that those who have low risk, that means high quality firms, they should be able to borrow at low interest rate from the market, but that won't happen because of asymmetric information. So let us see this issue, apply this one in the other market, lemons in the stock market, and also let us apply this concept in the bond market as well. So here see this fact, we are actually elaborating this fact in the stock market, discuss in the context of stock market and bond market. So in the stock market, what is going to happen? So you know that good firms who have those we can call them peach, they have high expected profit and low risk, and bad firms, that is lemons, you know that they have low expected profit and high risk. So you know that the investors willingness to pay is going to be the price of the average quality. Then what's going to happen in this market? Because of asymmetric information, you know that managers of good firms know more about their firm than the potential investors, right? So since as the managers of good firms know more about their firm than investors, so the firm with the good firms, they have less willingness to accept the average price for their stock, like the IPOs. They are not willing to accept the average price, the price for the average quality, because the investors willingness to pay will be the average of both, that we have already seen in the previous discussions. So what is going to happen? At the same time, this is about the managers of good firms, that means high quality firms. How about the low quality firms? That means about the lemons. You can see that the bad firms, they are in fact happy with the average quality price. You know why? Because obviously they are getting more than they actually deserve. So this is the case, since that it all is happened because of the asymmetric information. Then how about the investors? They do not want to buy stock of bad firms, obviously, right? You know that they want to earn dividend, and they also want to see earn capital gain in the days in the future. So they do not want to buy the stock of bad firms. So they end up with, actually they do not want to buy the stock of bad firms. So actually this market, it will be over represented by, it will be more with the bad firms. This market is going to be only with the bad firm. That is nothing but the point that we mentioned, adverse selection in the stock market, adverse selection in the equity market. Is better to call it as equity market, because stock means we already said that transaction in the already secondary market. So this you can say is the equity market. So in the equity market, you can say that there's going to happen, adverse selection is going to happen. That means the collapse of equity market, because investors finally, because it will be overrepresented by bad firms, then investors, they do not want to buy the IPOs of bad quality firms share. In the next session, we will continue this discussion, and at that time we will discuss, also apply the lemons in bond markets. Thank you.